Most millionaires actually keep more cash in the bank than the average person. So if the rich avoid banks, why are their bank balances much bigger than yours? The real lesson was never to avoid banks. That was never the true message. You should keep money in the bank, but only the amount you truly need. The real question isn't dollars. It's how much cash compared to your wealth. For many people, cash becomes far too much of their total financial picture. For wealthy people, cash is only a tiny piece of everything they own today. The rich figured out the perfect percentage long before most people ever do. Today I'll explain the simple math that completely changes how wealth grows. The evidence comes from one of America's most detailed wealth studies. The Survey of Consumer Finances reveals how families actually build wealth. Inside that report is one number that destroys a common money myth forever. Average families keep about 15% of their wealth sitting as cash. Millionaire households reduce that number to only 6% of total wealth. The richest 1% keeps only around 2% of wealth as cash. As wealth grows, the percentage of cash becomes smaller and smaller. Now let's stop using percentages and compare the real dollar amounts instead. The average household keeps around $13,000 available as cash. Millionaire households often keep over $120,000. They hold more cash than you, but it remains a much smaller share of wealth. Millionaires often keep nearly 10 times more cash than the average household. The richest 1% may keep nearly $700,000 in cash. Both statements are true, and that's where most people become confused. The wealthy keep more dollars, but cash stays a tiny part of their net worth. They never abandoned banks. They simply gave banks one specific purpose. The bank stores emergency cash, nothing more and nothing less than required. The real mistake is letting too much of your wealth sit there doing nothing. Idle cash may look safe, but it quietly stops working for your future. Banks don't leave your deposits locked away inside giant vaults forever. Instead, banks lend your money through mortgages, businesses, and car loans. They earn much higher returns than the tiny interest paid to depositors. Your savings become one of the bank's cheapest sources of business funding. You supply the money while the bank earns profits by putting it to work. That difference between borrowing and lending creates the bank's earnings. There's nothing unfair about it. That's simply how modern banking works. Once you understand this, the next lesson becomes incredibly simple. Instead of fighting banks, learn to make your own money start working. Your goal is to earn returns the same way banks earn returns every day. The biggest question isn't keeping cash. It's deciding where cash should go. The same Federal Reserve study shows exactly where wealthy people move money. As wealth grows, money doesn't stay in cash. It moves into productive assets. Business ownership rises dramatically as people climb the wealth ladder. Stock ownership also grows because businesses create wealth over time. The wealthy move money into assets that continue compounding every year. Today we'll explore 5 assets that help build lasting financial freedom. Before that, meet Jake and Marcus. Their story explains everything simply. Both are the same age and earn exactly the same yearly income. One day, both receive exactly $50,000 at the same time. They begin from the same starting point with the exact same opportunity. Only one financial decision will separate their futures over 30 years. Jake chooses the safest option and deposits every dollar into savings. The account feels secure, protected, and completely free from market risk. He believes safety alone is enough to protect his financial future. Everything seems fine because his balance never appears to lose money. Soon you'll discover the hidden price Jake pays for feeling completely safe. Marcus makes one important change before putting the rest of his money to work. He keeps enough cash for emergencies and refuses to leave more sitting idle. Every remaining dollar begins working inside productive long-term investments. Now imagine both men living through the exact same 30-year journey. We'll compare their results later, and the difference may surprise you. Before the 5 assets, let's clear up one common investing mistake first. This isn't about putting every dollar into gold and hoping for the best. It's also not about believing crypto alone will make you financially free. Gold and speculative assets can protect wealth, but they're not growth engines. If used at all, they should remain only a small part of your portfolio. Anyone selling them as the complete answer is selling emotion, not a plan. Real wealth grows through ordinary assets that quietly compound for decades. Asset number 1 is simple, boring, and incredibly powerful over time. A low-cost index fund lets you own thousands of companies at once. Instead of one stock, you buy the entire market in a single investment. Forget hot tips and trendy stocks that promise fast and easy riches. Owning the whole market spreads your risk across many successful businesses. History shows broad stock markets have rewarded patient investors for decades. Historically, the market returned around 10% before inflation on average. Some years soar higher, while others fall sharply without any warning. After inflation, long-term purchasing power growth averages closer to 7%. Jake's savings account cannot keep pace with rising prices over many years. Marcus becomes a part owner of thousands of businesses through one fund. That isn't gambling. It's ownership of companies creating value every day. Owning productive businesses is the foundation of long-term wealth creation. A simple shortcut called the Rule of 72 explains compound growth. Divide 72 by your yearly return to estimate doubling time. At roughly 7%, money doubles about every 11 years. Marcus's investment doubles once by simply staying invested long enough. Then it doubles again, making time more valuable than perfect timing. A third doubling creates powerful long-term growth through compounding. $1 can grow into nearly $7 after 3 long doublings. The secret isn't finding winners. It's giving investments enough time. Patient ownership beats chasing headlines, trends, and daily market moves. Marcus trusts time instead of trying to predict every market movement. Now compare that with Jake's tiny savings account earning almost nothing. At that rate, Jake's money would need thousands of years to double. That's why keeping too much cash becomes incredibly expensive over time. Now let's move to the second powerful asset wealthy people use first. Retirement accounts aren't investments. They're powerful tax-saving tools. These accounts help your investments grow while reducing unnecessary taxes. The biggest return often comes from taxes you never have to pay. The investment stays the same, but the account changes the outcome. Keeping investments tax-efficient allows more money to remain invested. That's why wealthy investors fill tax-advantaged accounts before anything else. Taxes quietly reduce investment growth year after year without many noticing. A tax-sheltered account lets more of your money stay invested longer. Even a tiny yearly tax drag compounds into a surprisingly large loss later. 0.5% sounds small until it compounds for 30 long years. That small annual cost can reduce your wealth by tens of thousands. The investment never changed. Only the account type made the difference. That's why wealthy investors fund these accounts before investing elsewhere. Health savings accounts offer one of the strongest tax advantages available. Qualified medical expenses can make HSA money tax-free at every stage. Keeping more of your returns is another powerful form of compound growth. Now let's explore the third asset used by many wealthy families today. Business ownership becomes much more common as wealth steadily increases. Business ownership rises dramatically among the richest households over time. For many wealthy people, their business becomes their largest valuable asset. At the top, businesses often become more valuable than homes or stocks. But don't mistake business ownership for effortless passive income every month. Building a successful business requires work, patience, and calculated risk. You can start one by one or own shares in an existing business. While risky, successful businesses can grow faster than many other assets. You no longer lend money to businesses, you become the business owner instead. Asset number 4 is income-producing real estate with careful planning. Imagine buying a $250,000 rental property today. You invest $50,000 as the property's down payment. That small investment now controls an asset worth 5 times more. If property values rise, the entire home's value gains, not just yours. Meanwhile, rental income helps cover part of the monthly mortgage payment. Over time, tenants gradually help reduce the remaining loan balance. After many years, leverage can greatly multiply your original investment. This explains why real estate has created many everyday millionaires. But now let's examine the part many videos choose to ignore. Properties need repairs that can quickly become expensive and unexpected. Heating systems, plumbing, and roofs eventually fail and need repairs. Sometimes tenants leave, leaving the property empty for several months. Mortgage payments continue even when no rental income is coming in. Property taxes and insurance costs continue rising year after year. Buying in the wrong location can reduce your long-term investment returns. Leverage magnifies profits, but it also magnifies losses just as much. Every reward from leverage comes with an equal increase in financial risk. No investment stays profitable every single year without periods of decline. Long-term success comes from patience, preparation, and realistic expectations. Markets don't rise forever. Every investment faces periods of painful declines. A 10% market return is a long-term average, not a yearly promise. Some years your portfolio will lose value before recovering over time. During market crashes, Jake's savings may seem like the smarter choice. A crash near retirement can seriously affect even the best financial plan. Every investment asks you to trade certainty today for future growth. Cash feels comforting because its balance rarely changes from day to day. Successful investors accept uncertainty because patience rewards them over decades. Now it's time to see where Jake and Marcus finished after 30 years. Both men experienced the same inflation, recessions, and market crashes. Jake kept every dollar inside his savings account for the entire journey. His bank paid a little interest, but the growth stayed extremely small. Meanwhile, inflation quietly reduced what Jake's money could actually buy. His $50,000 lost much of its real purchasing power. Jake never saw a loss on paper, yet inflation steadily reduced his wealth. Inflation never sends a warning, but it quietly steals buying power each year. Marcus kept only an emergency reserve while investing everything else. His investments continued compounding through both good years and difficult ones. 30 years later, Marcus built over $270,000. One simple decision created an enormous gap between two identical beginnings. Marcus finished with nearly 13 times more purchasing power than Jake. Their salaries never changed. One financial decision made all the difference. Marcus simply decided how much cash was enough and invested the rest. Now ask yourself how much cash you truly need sitting in your bank account. The right amount depends on your expenses, goals, and personal situation. The fifth asset is your emergency reserve kept in the right place. Keep enough cash to cover roughly 3 to 6 months of living expenses. Don't let that reserve sit forever in a low-interest savings account. Short-term treasury bills can offer better returns while remaining very safe. Money market funds can also provide easy access while earning more interest. A higher yield helps your emergency cash work harder without taking big risks. The same emergency fund can earn hundreds instead of only a few dollars. Use each financial tool for the purpose it was designed to serve. Keep enough cash for safety, then let the rest build long-term wealth. Let's review the complete strategy successful investors quietly follow every year. Own broad index funds, use tax advantages, build businesses, real estate, and reserves. The wealthy don't avoid banks. They avoid leaving too much money sitting there. Their secret is keeping cash as a small percentage of total net worth. Jake and Marcus started equally, but their financial choices changed everything. Decide what is enough, invest the rest wisely, and let time build your wealth.